And one of the most common ones that I think holds back scaling is the team is built in a way where a lot of stuff runs through the founder or CEO, and kind of everything runs through them. Some of the founders we've bought businesses from would tell you this, that for them, it was just really hard for them not to be so involved in the day-to-day that they couldn't really focus on the growth path, but you just don't have the time and resources to spend time on growth versus on maintaining the existing business. It can make it hard to really ramp up unit count.
If someone hasn't heard of Wonder, how would you describe the platform to them?
I think the simplest way is a holding company for franchise and multi-site businesses. I think a lot to unpack on what we focus on and all that, but at the end of the day, we acquire businesses that are either franchisors or multi-site corporate owned units, and we operate them as independent businesses. It's not some aggregation play. We might offer services across them and all that, but it's not like a roll-up or a platform necessarily. It's just us looking for great individual businesses and building out a portfolio where we think there's a lot of shared learnings and sort of our domain expertise becomes helpful. But happy to go as deep or not on what we do.
I think it's interesting. I feel like the platform play is so popular. I even just saw, this isn't a PE firm, but whether it's franchisors kind of turning into platforms or the typical PE platform shared services model seems to be what most companies are doing. You guys, like you said, multi-sector. So I know you have the holiday lighting franchise, then you have obviously the pizza factory, and then Soccer 5. So totally different industries, but why are you doing each one individually versus that platform style?
Yeah, I appreciate you telling the audience what we actually do since I didn't on the first one. So I think there's a couple different approaches you could take. When I think about the trade-off between platform play and how we do it, there are a lot of advantages to the platform in terms of, being super knowledgeable and focused on one thing, having shared corporate overhead. I totally get it. I think the trade-off is you can only look at a pretty narrow set of businesses. And so you may have to pay up to get those, right? You're in a niche and you're locked in there. For us, we're able to look across everything and have a lot of points of comparison of what we think based on the quality of the business and the valuation is a good deal, and then be pretty selective there. And so for us, it's not looking to make that platform play, but it's looking to just pick out what out of the hundreds of deals and businesses we've seen rates really favorably in certain areas. And so I think it's just a sort of different philosophical approach of, would you rather have more potential targets and be able to be a little more selective, or really hone in and have the advantage of a platform but have to pursue a smaller set number of businesses?
Okay, so basically the trade-off, there's a few things there, but primarily if you're going to build a platform, you really have to narrow in on. There's a lot of home services platforms I feel like that have popped up in the last few years. You're saying that kind of boxes you in to limited deal flow, and thus you might have to just pay up and have less freedom ultimately with what you can pursue.
Yeah, when you look at the franchisor universe, if you just look at the total number of franchisors in the country, there's a ton, right? But the total number of ones that are really sort of saleable businesses isn't a crazy high number. And so once you've sort of narrowed down to franchisors, to narrow it further with certain sectors, you get to a smallish universe. And so I think for us, having the optionality is something we value.
Okay. Yeah. And how do you think about the stage that you're going to come in at? Because Soccer 5 being your most recent deal, which we can get into in more detail later on, but that was much more emerging than, say, Pizza Factory that already had 100 plus locations.
Yeah. And if I get going too long on any of these, just cut me off, because there's a lot of nuance to all of these things.
Yeah.
Right? When I think about the deals we've looked at, each of them is different in why we select them. And so in terms of stage, we need enough proof points that, hey, we think this is a replicable concept and we can scale it. But that can take different forms, right? Soccer 5 is on the low end of that with 6 units, and there's 6 exceptionally high-performing units. And we think it's something we can take and grow both on the corporate side and the franchise side. And then I think, much below that, it's hard to know whether you could translate this to a different geography or is it dependent on one operator, stuff like that. But obviously then we have systems up to Pizza Factory has over 100 restaurants, and Christmas Decor, the decor group, our Christmas lighting business has like 200 franchisees. It's territory based. So we'll come in at different stages. You could quantify it by number of franchisees, system sales, et cetera, a bunch of different ways. But essentially, like, we'll look at anything that we think has a really strong underlying business and enough proof points that we believe that it can scale and has longevity and all that.
Okay. So repeatability seems to be like a key thing that you're gauging during diligence, right? Like, you guys obviously don't want to come in there and reinvent the wheel, or even maybe, is it like, this is more qualitative, I think, than a quantitative angle I'm taking, but are you mainly trying to figure out, is the model just dialed in to the point where you guys can maybe make it more efficient, but you're not having to like you don't want to invest at a point where there's still work to be done on figuring out exactly whether if it's a 4-wall concept, like what the 4 walls look like, what's on the menu, so to speak. You guys want that all done, but then assuming that works, that's what you're gauging for, and it's less about X number of units or whatever.
Yeah, I think that's fair in the sense of like the work on the initial model is done. I think there's still a ton of work to be done to grow the business, because being able to operate, 1 or 2 or 5 units of something is a lot different than more than that. But yeah, I think for us, we're looking for things that we believe in the underlying model. And, that doesn't mean the same thing in each case, but we're not, looking to do turnarounds in the sense of like, there's a broken unit level model, let's go fix it. It's more like, hey, we see a lot of businesses, both, franchisor and not, where there's a good underlying business, but it's not in position to be scaled, whether it's because that's not the desire of current ownership or whatever limitation. And, it's a very different thing to run a big, by our standards of business, versus a small one. And so for us, it's really coming in and saying, okay, there's a good underlying business. Like, we think we can be additive in scaling this thing versus, hey, we want to fundamentally change the model. Like, we generally think the people who have built this, like, know more about the unit level business than we do. And hopefully we can come in and find incremental improvements, but we look for ones where we think they've generally got a pretty good thing going.
You mentioned how there's always challenges with scaling. Can you talk more about what that is? Because I feel like a lot of folks, especially whether it's franchise buyers or emerging franchisors, there seems to be sometimes like a bit of a rosy perception of, I have a couple locations that work, I'm going to franchise it, and it'll be easy and I'll get my big private equity exit. But you've seen a lot of different deals, a lot of different brands, and are obviously working as owners of multiple brands now. I mean, what are the challenges of scaling, even when you have that 4-wall concept that maybe does work at the unit level?
Yeah, there's a lot there. And it depends if you're looking to do corporate units or franchise growth. They're very different businesses. But, one thing I'll say is, I think when people just look at the idea of franchising, it's obviously like very appealing in a lot of ways, because once you get to scale, you can grow really nicely. It's asset light, like the flow through on revenue is high, right? Like, once you have your corporate overhead in place, for each 20, 30 franchisees you bring on, you might only need one more support person. And so like, people are looking at the sort of upside, which is very real. It's just a really long road to go from no franchise units to like a meaningful royalty stream. Like, you're going to spend a long time, sort of in the red on that, where you have to build out a team to support these people. And, the undertaking of helping other people run a business, it's just a very real challenge and takes a while to get there. And so I think just more generally, when we look at small businesses, and, I should have mentioned earlier, but Wonder is one of the investment platforms of Tucker's Farm, which has several other investment platforms that aren't focused on franchise businesses, but, operate in a similar part of the market in terms of scale. And so we see this all over, which is like, it's not always the same set of challenges to like go 0 to 1 or 0 to 5 as it is to really scale. And the type of skill set, type of person that is good at those things isn't always the same. And I think when we talk to a lot of founders, CEOs of small businesses, like, they'll talk about the challenges they face. And one of the most common ones that I think holds back scaling is the team is built in a way where a lot of stuff runs through the founder or CEO, and kind of everything runs through them. And so that becomes very hard for them to focus on growth and not be in the day-to-day of things. And so when we look at a business, we spend time on thinking about, who do we need to bring in and how do we make sure people are focused on the things that allow us enough time to scale. And I think some of the founders we bought businesses from would tell you this, that for them, it was just really hard for them not to like be so involved in the day to day that they couldn't really focus on the growth path. And so I think one of the things is if you have a good underlying model, but you just don't have the like time and resources to spend time on growth versus on maintaining the existing business, it can make it hard to really ramp up unit count.
Are you talking about founders being stuck in like their corporate units, or do you just mean even like within the franchising side of things? Is it like a classic just delegation problem? I think a lot of founders have a hard time with that, right? They stay too in the weeds because they're so obsessed with maybe like quality or their brand or whatever the case is. But is that kind of what you're getting at, where they just can't really stomach delegating certain tasks and can't get to a point where they're working on the business?
Yeah, I think the short answer is yes. And obviously it doesn't apply to everybody, but like, you know, in the founders we've met, both businesses we bought and not, like that's been a personal reflection of them also, which is like, hey, the way I run this, it's hard for me to grow it, but like I haven't put the team around me that makes me feel comfortable handing enough stuff off that I can really focus on growth. And obviously, you know, there's a bit of intertwining of like most of these businesses start off with at least a couple corporate units where they prove the concept and then they go to franchising. And so oftentimes the founder is kind of involved in both sides of those businesses. But yeah, I think the short answer is yes, like the working in the business to working on the business thing, which is cliche, but it's very real.
How do you think about differentiation in this just broader role or realm of like small businesses? I think it's a lot of times I speak to people who they'll pass on, you know, whether it's for us when we're working with people who maybe want to buy an emerging franchise, or on the flip side, we're working with bigger multi-unit franchisees who are selling their business, and then we're marketing that to buyers. Sometimes we'll hear, and it's usually from people who don't really come from the franchise or small business world, they have no experience in it, and they'll just look at a concept and they'll tear things apart that objectively may have good numbers, but they'll say like, oh, this has no differentiation, X, Y, and Z. I don't know if it's like a tech approach to investing where maybe product and feature differentiation and things like that matter because things can change so quickly. But yeah, anyway, how do you just think about what's defensible in this world of small business? Because I think if I could figure it out, I'm not saying I do a good job, I could start a pizza business probably in the next year or two, right? There is, in some sense, there's low barriers to entry to a lot of categories of franchising and small business. The execution is a massive spectrum. So yeah, I'm just curious, how do you think about what's defensible? What does differentiation mean in this world?
Yeah, and I think it, depending on the category, probably varies a bit. But there's a few things. I mean, one is, you know, like how long has the concept been around and how well has it performed, right? Like in tech, there might be sort of like a fundamental shift one day to the next. Like in pizza, like, you know, obviously if there's more entrants coming in the market than there is sort of growth in demand, like that's not great, but probably like not a fundamental change in pizza coming tomorrow. And so if a brand's been around a while and, you know, has performed well in terms of unit economics, like, you know, that gives you some confidence. And, you know, unlike some tech things, like not everything's a winner take all market, right? Like there are a bunch of different concepts that exist and continue to succeed. So for us, like, it's a little bit of like, do we think the product you're selling, which is a business to a franchisee, is that a good one in this like scope of both their alternatives within the category versus other things versus changes in the market? And so I think for us, like, it's not always like, hey, night and day, this is different than something else, but there's room for there to be a bunch of versions of models that work. And the more proof points there are, the better. And it depends how mature a market is, right? Small-sided soccer, like Soccer 5, it's a little bit different where I think there's plenty of room to grow. And I think there's also a very real part, and it goes back to the unit economics of just, there are a lot of pizza places that make a lot of money and there are a lot that go out of business, right? Like there's a real execution piece. And what you're hoping to get in a franchisor is like, hey, you've rolled out a model that is highly likely to make people succeed and stay open, right? And so there's a true like difference, even if you would say it's not you have McDonald's brand or you don't, but you know, do these operators generally succeed or not? You know, it's not uniform.
Yeah. And speaking of the operators, I mean, how do you factor that in from a diligence perspective, and maybe even, I don't know, if it's the health of a franchise system, or maybe it could increase risk depending on the number of units per franchisee? I think there's two schools of thought. One end is I see brands like Crumble's kind of notorious for this. They've done a deliberate job of limiting franchisee growth. And then there's other brands where, you know, Greg Flynn, I think, owns 1 out of every 5 Pizza Huts in America are owned by Greg Flynn, which is absolutely insane. I'd say like folks who are more in the Crumble camp would say they don't want their franchisees to have too much power and influence, right? I guess if you own a number of units, you can push back on certain changes and you develop more authority within the system. I think that's the thought process. And then the other side of it, though, is like, if you're a good franchisee, I want you to own as many units as possible because like it's less training, less resources from the franchisor. It's arguably higher royalties if the units are performing. I could go on, but yeah, I'm just curious. Have you thought about that as you look at acquisitions of these brands?
Yeah, I think in general for franchisors, you probably want to limit, concentration to some degree. I think most systems have some limit on it. Like if you're, maybe it's 20%, for example, in Pizza Hut, but maybe for some people it's lower. You obviously don't want to be in a position where one franchisee is, your entire system. For us, it's not really an issue in our existing ones because, without going deep in the weeds, like it's a little closer owner-operator stuff. And so like in Pizza Factory or Christmas Decor, like there might be people who have multiple units or territories, but there's no one who has a significant portion of the system. And so I think in general, when we're looking at concepts, it's something we would evaluate, but in our current systems, it's not a huge issue. And I think just the other thing I'll just mention about Wonder's approach is like we have a fairly long-term mindset. And so we are not necessarily saying, hey, we got to grow unit count as much as we can immediately. And so like that changes, I think, a little bit of what you're focused on and what your concerns are. If you're trying to grow super fast, having some big groups in your system obviously helps. I think for us, it's a more like, how many units can we add that are likely to stay open and sort of sustainably grow whatever over time? And so oftentimes, like, we won't be the highest bidder on some hot things where someone's like, hey, we can triple unit count, next year, because that's not really our approach. But if you want to do that, it's hard to do that one by one, right?
Can you maybe dive into more of the approach at Wonder? You mentioned it's longer term. Is that like both for the brand, the franchisees, and your, I don't know, I guess time horizon for holding these investments? What's kind of your internal thoughts on that?
Yeah, I think generally we look at things on a 5 to 10 year time frame. Like we're not looking to do anything where we come in and try to grow super quickly and transact in a few years, which I think is very viable for some of these fast growing systems, right? And I think some people had great outcomes. For us, we're really looking for like, what do we think is a pretty solid business that we can continue to grow. And what that means for each business is different, right? Like for Soccer 5, that's going to look a lot different than Pizza Factory. We could have good outcomes in some of our systems without growing an amount that a lot of people would look at and say, hey, why aren't you growing double digits a year? And it's like, well, that may not be the right thing depending if you're doing an owner operator that, is one at a time. We're more focused on sort of like the net, which is we don't want people closing, right? It takes a disproportionate amount of your time when you have, franchisees who are struggling or unhappy. So for us, we're just looking over the long term. Like if we can have positive same store sales and we can have positive unit growth, we're probably gonna have a pretty good outcome. And one of the trade-offs there is you're probably not gonna be the highest bidder on something that's a super, super hot kind of rocket ship because we don't really want to put ourselves in a position where we've modeled such explosive growth that we then have to grow at all costs, even if that means bringing in franchisees who aren't the right fit, aren't likely to succeed, et cetera.
Yeah, no, I mean, it's so difficult to execute. I mean, to me, it just speaks to the impressiveness of, say, a Dave's Hot Chicken, who they've grown, or even like Seven Brews, kind of the hot one right this second. What are your view on brands? And I'm not trying to pick on them. I mean, they've done fantastic so far, but they definitely capitalized on marketing hype, whether it's a Seven Brew or a Dave's Hot Chicken. I mean, would that scare you from an investment standpoint? I feel like these brands get premium valuations. Like Dave's Hot Chicken sold for $1 billion. You could take a conservative side of that argument and think like, hey, they've done really well so far, but there's a lot of TikTok and Instagram hype that's actually gotten them to this point. From as far as driving foot traffic to stores, it's still relatively new in the grand scheme of fast food fried chicken, right? So yeah, how do you view a brand like that that's objectively today like crushing it on unit level economics, but it is still at the same time a very new franchisee base and there's still a lot of growth happening very quickly?
Well, I want to preface this by saying like a lot of smart people have thought a lot more about those brands than I have. And so I don't spend that much time on brands that are far up market from us. And so, take this with a grain of salt because I'm sure these people have thought all of this through. But I mean, one is, I think part of the premium valuation comes from the unit economics of those brands have been really, really strong, right?
Oh, yeah.
So they do deserve credit for that. And I think when you're modeling something, it's like if the unit economics are really strong and we think there's a lot of white space and we can grow unit count a ton, like the multiple you're paying can look very different after a little bit of growth. And so I get the premise behind them. It ties in interestingly with something you said earlier about differentiation. From the outside, we're not in the fried chicken or coffee market right now. And again, I don't spend that much time on those big brands, but obviously there are several brands in each of those categories growing a lot. And you'd think at some point, sort of like supply outpaces demand, but to date, they've all performed really well. And so I don't know if it's like marketing hype. I mean, I think they've done a good job with their brands, but they've also both sold a lot of units and those units have performed well. And so I think there's a very real story of like why you get excited about it. It's just trying to project like how many more years can you grow this way and have the units perform really well and all that. But again, not something I'm deep enough into to really analyze.
Sure. Yeah, I think that's kind of always my thought process is the hype and even that novelty factor that I think they capitalize on once you kind of you get that label and that perception as like the cool new brand on the block. There's an expiration on it. It's not going to last forever. It's kind of the way like an underdog sports team, everyone roots for them, but if they keep performing well, eventually everyone's going to hate them and they're going to like the Golden State Warriors. There's a version of that in franchising where it's like you're the cool new kid on the block, but eventually people are going to get sick of you and you're just going to be some big evil established brand. And it's like, what do you revert to when you're in your steady state like that? That's what I would model in, but I'm definitely not smart enough.
Well, what I'll say there is I think the difference with this and the sports team is if your units keep making people a lot of money, people are going to keep opening them. And so like, I think even if you become a little bit more of like a less cool, fun brand and more big corporate, whatever, obviously people are going to do what's in their self-interest. And if these units keep producing a bunch of money, franchisees will keep opening them. So as I think to me, it's a little bit of like, does the market get saturated? Do they stop doing as well at a unit level either because of that or because they had to bring in so many people they couldn't bring in as high quality people, whatever. Like once the unit economics start to fall, I think it'll change. But if they can keep this up, they can probably keep it going.
100%. It'll be interesting to watch for sure. And I also think it's just worth calling out. Like I've been mentioning Dave's Hot Chicken and Seven Brew. I mean, they had from a very early standpoint, legitimate, not just capital behind them, but the teams that have been scaling them, experienced franchisor teams that have done it with other brands and scaled to hundreds of units. So it's very different than what I've looked at with your typical emerging franchisor where it's, someone who's probably frankly just owned their business for a few years. Maybe they have a few locations, but they have zero franchising experience. They don't know how the game is played at all. And it's just totally different ends of the spectrum, the teams running them. And that makes a big difference in my eyes. So what do you see with emerging franchisors? Is there a common set of mistakes that you see that they've made for you if you're like evaluating an investment for a franchisor and you end up passing? Like, is there a common set of, characteristics that kind of cause you to lean out on a deal?
Yeah. I mean, I think at the core, we're looking for, strength of unit economics and potential to grow it over a long period. But one thing we hear a lot is almost everyone I talk to says early on, we took all the, anyone we could get, and now we've had to do like a clean out later. And with that said, like it's easy on the other side to be like, oh, you shouldn't have done that. But it's really hard when you're getting going. People want to be franchisees. Like that is your business. You don't have unlimited demand early on. Like it's hard to say no to people. And you're still figuring out like, what is the right profile of my target franchisee? And so I think it's a very common mistake, but it's a hard one to avoid. And I think it's one with Soccer 5 where we're just being pretty measured. Like it's a cool category. People are excited about it. We could grow unit count very quickly. It's not what we're going to do. Like someday we hope to grow it very quickly, but not now. We want to make sure we've kind of nailed both the playbook for franchisees and also the vetting process for them. And so I think that's probably the most common thing I hear is like, it took us a while to figure out who the right franchisees were and we had to do some clean out. And the second one is, if you've operated a couple businesses and you start franchising after you have 25 franchisees or whatever, you just know so much more. I mean, you're getting so many more data points of problems they run into, different variations of stuff that like the next 25, you're so much better because again, there's differences in market, operator, et cetera. And so I think, just inherent to this, like they just get better at it over time. And so they may have even said like, hey, I wasn't prepared to really support these people early on. And so partly it was I brought in the wrong people and partly they just weren't set up for success the way people are currently. So those are a couple of the things that I think are challenges early on. Doesn't mean we would necessarily pass on them because maybe they've been remedied. But I think ultimately getting on the other side of that and getting to franchisees who are succeeding, that's what we need to see.
Yeah, I see that all the time. It's the biggest mistake brands make. And especially first-time franchisor. I mean, when you combine that with a lot of times they end up bringing in their first franchisees who are first-time business owners. I kind of describe it as it becomes this like compound startup because you have basically a startup franchisor with no experience in being a franchisor, which is a totally different business in reality than, whatever they did to launch their corporate business. And then you have the first-time franchisee who's never been a small business owner. And combining those two, the spectrum of risk, I think, is just multiplied. and it usually doesn't end well. So I don't know what the solution is. I try to tell brands, but like you said, it's so hard when you're starting out and they're trying to grow. So I get why it happens.
Yeah, I mean, it's not like they have like unlimited number of people who want to, become a
Exactly.
franchisee when they're starting out. So they have to, they have to work with what they've got. What I
Yeah.
will say is also there's just one of the challenges of franchising in general is you're essentially hiring franchisees, right? Like it's very similar like hiring employees in that evaluation process because you're betting on them going and being, a good business owner. And I think everyone knows how hard hiring is in general, right? Like nobody's like, hey, I get 100% of my hires right. And so it's just a challenge. That's a challenging part of it. Even once you're, experienced in what you think you want, you're just never going to be perfect in vetting these people. What I do think is important is the same way, for us, like we're big believers in having a hiring scorecard. We certainly didn't invent this, but essentially like, what are the outcomes that you need to accomplish? What are the attributes that we think are necessary to accomplish those? And then how do we evaluate those? I think what we want to see with our systems is putting in a similar sort of like hiring scorecard for franchisees of like, what really is the scorecard for the traits or experience or attributes that we need from a franchisee that we think they're likely to succeed? Because when I talk to, one of the things that surprised me is as I've talked to, hundreds of franchisors over the last couple of years, even when they're further along, they'll say we're better than we were, but like it's hard for them to articulate exactly who they're looking for because it's not going to fit in one box. And so it's kind of an ongoing challenging problem, just like, hiring's hard.
Yeah. I mean, I think not saying franchisors are beggars, but like the saying beggars can't be choosers. I just think the fact that there is that reality that it's not like you just get your pick of the litter and get to say, oh, I want that one, that one, that one. Like, right. It's like you have a finite number of candidates in every given moment. And yeah, you got to make the best of it to some extent if you do want to grow, or you have to figure things out to attract a higher quality if you're just way off the mark. So I want to talk about Soccer 5, much different investment than your prior two as far as the size of the business and the stage they're at. So yeah, can you just walk us through Soccer 5 as a business and what drew you to that brand?
So yeah, the first two, Christmas Decor and Pizza Factory, they're a little bit more mature and they're pretty pure franchisor. Like, Christmas Decor, there's no corporate units or territories, and Pizza Factory, there's just one corporate unit, the rest are franchised. Soccer 5 is different. It's 6 corporate units based in Florida right now, and they, before we got involved, had launched the franchisor, and they'll have their first franchisees opening in early 2026. For us, it was really like, we think it's a growing category and we think they've got a really good model. Like their unit economics are really strong in all of those units. And we believe it's something we can go, replicate other places. And so for us, we're unlike the other two, we're going to do some corporate unit growth while we also do franchising, which pro of that is like you got two great growth levers. The con is like, it's hard enough to run one good business and now you got to run 2 good businesses because a franchisor is really a different thing than a corporate business. But it's a very different one, but like I said early on, we look at so many deals that we just look for the ones that stand out to us, and that can take very different forms, right? And this was one where we were just super impressed by the unit economics and the opportunity ahead. And so even though it was earlier than we go and a little different focus instead of pure franchise growth, we just thought it was the right opportunity for us. We hit it off with the founders there who are staying involved. Scott is actually founded by a father and son who are Scottish and looked it over in the UK like, hey, there's small-sided soccer is a big thing. Like, why don't we have that in the US? And I think the sort of miniaturization of sports is a pretty real thing. Like, people like pickleball, it's like more action for your time. And so I think it's a cool concept. And they brought it over here. They launched it like 15 years ago without taking the whole history. Alan, the father, he's staying involved. He leads sort of the construction side of things. Scott is the son. He is staying on as company president. And so we just thought with their ability to, their knowledge of how to operate these units and the stuff we bring from sort of like the finance side of things and like capital raising, capital allocation, high level strategy, higher as the business grows, there's a good pairing there. And so we think there's a chance to grow both a good franchisor and a good corporate business.
And as far as the actual concept, right, that they developed, it's turf fields. They're basically building these turf fields that you then, I know for some of them, they partnered with municipalities. So high schools and stuff can practice there, or is it literally like all recreation based and primarily people like me who used to play soccer in my early 30s? I can't run nearly as much as I used to in college when I played, but I can join a rec league and play like 5-a-side with my friends.
Yeah. Again, I guess I should actually tell them what the business is.
No,
Huh? So, yeah, what it is Small-sided soccer is, instead of a full-size 11v11 field, it's like 5-on-5 or 7-on-7. In Soccer 5's case, right now all their facilities are outdoors. There is an indoor version that actually, our first corporate one will be open early December, and the first franchise one will be open early 2026. But the outdoor ones, it's fenced in, it's turf, and it's like a high quality playing experience because it's well built. The business is split into a couple components. The biggest one, which surprises people, is generally adults playing in leagues or pickup in the evenings and on weekends. And then there's what we call academy, which is youth programs. And there are several different youth programs, but kids, ranging from very young up through high school, getting various levels of training. And so it's multifaceted, but, it caters to a lot of different people. And, in the areas it's drawn a lot of customer interest. And I think in part it goes back to what we said earlier of just like, one, it's not like a saturated market, but two, it's how you operate it. Like they provide a really, really strong customer experience. People really like playing there and the stuff's well built. And so that's something we need to replicate going forward is, it's a challenge with franchising, right? Like how do you continue to have the best customer experience when you're not the ones running it, right?
Well, do you guys, the Soccer 5, have to market the facilities and create the rec league, so to speak? Or is it different where you just find existing, like I'm in the New York City area, so there's a couple big ones where if you want to do like a rec league, you can do pickleball, you can do volleyball, you can play any sport in New York. And then there's a couple companies where you just sign up with the team there and they like partner with a bunch of different facilities throughout the city. So are you partnering with those organizations, or are you guys, once you build a field, it's like, hey, you now have a soccer field in your area, invite some friends, form a team, like here's a league, there's league play every week, right? Kind of like bowling alleys, I think, do that.
Yeah. I guess it's more the latter in that you're opening a facility and then it's marketed to everyone in the area, right? And so it can be you sign up just to come play pickup. You can sign up to be part of a league. Like there's the different variations. But yeah, it's like if we open in a new area, we need to get word out to people in the area. So for like academy, it might be more targeted with you're talking to schools and youth programs and clubs and all that. For the adult stuff, it's probably a little more like direct to consumer.
Sure. And what was it about Soccer 5? Because you mentioned the corporate development. What's your metrics that you want to see a concept hit from? I don't know, is it payback period? Is it, the cash on cash return? What about it was like, okay, this is actually a better fit to also develop corporate units for?
It being high ROI, cash on cash returns is key. And without going too specific on different things, different numbers, the existing units had performed very well. It's also just absolute dollars that a unit produces, right? Like there are a lot of home services brands where the ROI is exceptional because the initial investment's super low, but the AUV is not high enough for it to not be like owner operator, or it's not high enough that it's when you take the AUV and you multiply it by the high margin, you get EBITDA, but it's not enough for someone who wants to build like a really big business to do it, maybe eventually. But the difference for us when we look at this is, hey, it's a big enough business, not only high ROI, but enough absolute dollars coming out of it in EBITDA per unit or unit level profit that it's worth us undertaking it as a corporate thing versus purely franchising it. And so I think the scale of the units is important in addition to ROI.
Okay, so you're looking probably, I'm going to cherry pick one of the best examples, but like Planet Fitness. What is it? I don't know what the FTD is nowadays. I know it can be super expensive to develop. I think maybe a decade ago, though, you're printing 500, 600 grand per year on a $1.5 million investment. That's 10 years ago. I mean, the cash flow is still just as good, if not higher now, but the build out costs, like every brick and mortar brand, has just shot up, unfortunately. But is that kind of more what you're talking about? Like you're looking for healthy mid six figure minimum cash flow for a unit?
Exactly. Yeah. I mean, if you just think about like Subway versus Chipotle, right? Like it'd be really hard to build Subway as purely a corporate business because you need so many units because it's lower AUV and EBITDA and all that. Whereas Chipotle, I think they look at it and they're like, hey, the simplest way to generate value is us to just keep building these big box, high AUV, high ROI things. And so that's what differentiates this versus some other things is you don't need to build hundreds of these to have a meaningful business.
Yeah, it makes total sense. When you look at franchising in general, from a private equity standpoint, like why do you think, because there's been a lot written about this lately, that private equity in franchising is just becoming more prevalent? I mean, what is it about it that makes it more attractive than a general small business PE fund, which you'd probably have some insight into given Wonder being a part of the broader Tucker's Farm platform?
Yeah. I think in general, private equity's come down market in things just from looking for more opportunities to deploy what's become a lot of dry powder. But specific to franchising, it is a desirable model, right? Like it's one of the reasons we like it. And what I mean by that is, again, once you've gotten to a certain amount of corporate overhead where you kind of have the team built out and all that, the incremental cost as you scale isn't super high because you're generally adding support people. And so the flow through on incremental revenue over time gets very high. And so franchisors at scale end up they end up being pretty high margin businesses. And also it's asset light. Like you're not the ones putting out the capital to build stuff. You don't own a ton of stuff. And you have this, at least in theory, diversified royalty base, right? Like I would say it's not fully diversified in the sense that a lot of these franchisees' business success is correlated, but you obviously have a lot less risk than if you could have 5 corporate units or many more franchise units and be at the same amount of revenue, EBITDA, whatever. And one of those is much more concentrated and has more risk of, one unit struggling. And so I think between the scalability that it's asset light and that you have this diversified royalty base, it's just a very appealing model if PE looks at it and goes, hey, there's this concept that has great unit economics and a lot of white space, and we can really scale this thing.
Yeah. And what do you think, though, the PE firms maybe get wrong who are approaching franchising? Meaning, I hear you and I agree, right? It's asset light. At scale, the margins do get really, really good. And I have my own thoughts on this, but what is the hard part? Because I think a lot of people don't really think about the hard part. It's not easy to get to that level where you're just adding 30 franchisees and you only have to hire 1 extra or 2 extra support people to fund that or to support that incremental, probably million or 2 million plus in royalty revenue that's generating. Yeah, like what are the parts that maybe every business is hard, I think is what I'm getting at. What's the hard part in franchising that maybe outsiders who think this space is like the ultimate money printer, that what are they not seeing?
I think the part we haven't talked as much, we talked a lot about the strength of unit economics. The other part of like doing a deal is like the price of the business, right? And so I think one of the things, and again, I'm sure like a lot of these PE firms are going to make a lot of money on a bunch of these investments. And so it's not to say that like in general they're getting them wrong, but for the ones that do go wrong, I think the business goes to the highest bidder, right? And so if you pay a multiple that puts you in a position where you need to grow at all costs, and either it turns out that there wasn't white space as you thought, or it's harder to find franchisees or whatever, and the growth's not there, you just paid a multiple that is not going to lead to a good investment. Like for us, sometimes we bid and the banker comes back and is like, someone was 50% higher than you. And it's like, what happened there is that person just had a much more optimistic base case of what growth is going to look like. And we didn't feel comfortable underwriting that. And so I think there are a lot of people underwriting continued really fast growth for all these things. And I think we know that that's not always how things go. Like sometimes it plateaus, whether it's because too many market entrants or, different preferences and consumer demand shifts, or they bet on it early when they were in super fast growth mode before the model was really proven out. And it just turned out it's not that good a unit economic model. And so once, to your point, the marketing hype wears off, it's hard to keep growing. Like we do see some concepts where people pay a price that we're like, oh, you must have high confidence this is going to keep growing really fast. But it's early enough in the brand's history that like they don't have a vast set of really high performing data. And so there's a little bit of a leap of faith there. And I think that can, if you're right, you probably make a lot of money. If you're wrong, you're in a tough spot.
Yeah, I totally agree. I think from the earliest stage emerging franchisors to even more upstream folks who are evaluating deals in your realm, or maybe it's 100 units, I feel like that's the thing I see the most is, and I just know this from working in franchise development and doing various things, through content and helping brands scale and talking to brands. Everyone really underestimates how hard it is to grow, and they just think it's going to happen. And then it turns out you have a franchise, you're marketing it, and oh, wait, this is, some people are saying no to this franchise and, we're not getting as high quality of operator interest as we thought we would. And everyone always thinks it's going to be way easier than it is in reality. So yeah, that would be just, I don't know how there's ways to probably gauge that before you do a deal, I think. But yeah, I'm in total agreement with you.
I think when you're underwriting a deal, like you'd ideally want to be in your model projecting growth that you believe is like at a level that you can still be selective on franchisees, right? It's not like for us to hit what we're modeling, we have to take everybody. You want to have like excess demand on franchisees and be selective, because the main problem I talked about is like you're not able to grow unit count. The other problem you have is like if you had to grow unit count, bring in franchisees who are not likely to succeed, that's a short-term solve and it's not going to work out long-term. And I think there's some of that, which I think you were alluding to.
Yeah, definitely. End of the day, keeping kind of those main priorities. Franchisee selection matters, franchisee profitability matters, and the only way you do that is you got to pick good operators, but you can't do it at a rate that's unsustainable. So
easier said than done.
Yeah. It's easy to like
unit economics. It's hard to actually improve them. And, even if you can be selective on franchisees, like knowing who's going to be a franchisee, it's just hard. Like I talked about earlier with hiring, like it's just, you don't really know, but you got to have a good scorecard and system in place to evaluate.
As far as deal prices, and I'm going to enter what I call like a speculative but kind of fun part of the conversation, which is deal prices. And I'm asking this specifically as it relates to, say, to Rourke Capital, who anyone in the franchise world knows them, knows who they are. They don't know much about them. And I know you don't have like insider knowledge or anything, but you're the first private equity person we've had on the show. So I think you'd be able to speak to it with some level of insight that past guests would have no clue. Something just as an outsider, and right, I'm not a private equity guy, but I just noticed they pay expensive prices for all the brands that they acquire, whether it was Dunkin' back in 2020, Subway is a recent one, Dave's Hot Chicken, they paid up close to $1 billion valuation. I mean, I think there's a few things. It's the IRR has to be impacted greatly. That's how I think. I'm like, okay, their internal rate of return all of a sudden it's got to be going down if they're paying, even if it's a great brand. It's like you just paid 20, 30 times earnings on that. And then secondly, they don't seem to sell brands, which is confusing to me for private equity, because most are 4 to 6 year timeline from what I understand, right? They're going to buy a brand, make it more efficient, do whatever they got to do, and sell it for some multiple of that. 4 to 6 years down the road is the goal, because the LPs who invested want some return, and that's the model from what I understand. But Rourke's clearly doing something differently. So like, how is that working? Just again, from your outsider view, is there a different model in massive private equity firms that are playing with billions and billions of assets under management?
Yeah, well, first I got to say, you refer to me as a PE guy. I don't think the people sitting in a Blackstone tower right now would consider. I'm sitting in my basement here, but I don't know that they would consider me one of them. But I guess technically we are.
You're more PE than me, man.
We are private equity capital, I guess. Yeah. But yeah, so I don't spend a lot of time thinking about Rourke, and I don't want to pretend I know much about them specifically. I'll just speak kind of in general to your questions. When you see crazy high multiples, like this is reductive, but like there's at least two sort of key things there. One is like how much is it going to grow, right? Like if it's going to grow a lot, the effective multiple can look very different pretty quickly. Obviously, you don't know if you can grow it, but like anytime you're paying a crazy multiple, you're almost definitely projecting a ton of future growth, right? And sometimes in franchising, like it can almost be like exponential, right? Like you've seen some of these brands lately, like you mentioned a couple of them earlier, that like their growth is crazy compared to what most sort of non-franchise businesses might look like. And so growth is a huge part of the underwrite. And then the other one for a lot of these platforms is, if you're going to be able to cut most of the corporate overhead out because you have most of these resources, the EBITDA you're buying at the time is actually higher than it is on paper. And so I think that's another part of it. But these cost synergies, like how much of them are real, I think for these platforms, they're pretty real, but that's probably part of the underwrite. And then the last part is just, I think people have paid some really high multiples, and if you don't grow really fast, sometimes it doesn't work out. In terms of the hold period, there's a bunch of dynamics there. I mean, in general, in private equity, there's this, real incentive to transact and, have a track record that you can show and go raise more money because, ultimately assets under management is a real valuable thing for private equity firms. Obviously, it's not the game we play, but it's hard to just hold things forever because you're not able to go as easily raise the next thing. But also there is value in empirically, and Kyle Tucker talks about this all the time, that like a lot of the value in a lot of all-time great businesses, it compounds late, right? Like once you've scaled it and it's producing a ton of earnings per year relative to like what you got in at, like, it can really compound over time. And so like, I'm sure they'll sell them at some time, but like if they can hold these for a pretty long time, there's a big advantage to that in your returns if you're continuing to grow. The trade-off is most investor bases want an exit at some point. And so it depends on what pool of capital you have. I think, frankly, it's a huge advantage like we have to have long-term investors who are okay with us holding for, if we want to, 10 plus years. And I think for Rourke, that's probably a big advantage is like you can hold your winners and it can compound over time.
So the LP pool can dictate what you're able to hold at. And like, I just think of Rourke. I mean, I think the first brand they bought was Carvel back in 2001 to 2002, and they still own them. So are investors just waiting for that? Or is there like a dividend that you can eventually like rewrite the deal and start paying them dividends? Because I don't see how an investor's cool with sitting on Carvel for 20 years.
I don't know their exact structure if they had a continuation vehicle, because like there can be things like that, right? Where there's one set of investors and then you raise a new fund from investors, a continuation vehicle, and you're still in control as Rourke, but the first investors got their money back and the next set of investors who believes in this next phase of growth takes over. So could be something like that. Obviously, they also could be, distributing profits out. Like it's sort of, I don't know how they're structured, to be honest, but you can find a way for your LPs to get liquidity, but it's not always super easy. And so generally things transact sooner than later because people want to capture the win and exit. But if you're able to hold, there's, you can really have some compounding towards the end.
I gotcha. Okay. So they're, in short, for non-finance guys like myself, not that you're a PE guy or a finance guy, but there are vehicles to capture. And maybe I'm familiar with startups where there's, secondary shares become a conversation by the Series B standpoint typically. So there's avenues to kind of bring in new money and let the first investors or shareholders kind of exit.
My guess is that the current LP base of an investment made in 2001 is, unless they had a very unique set of investors in 2001, is probably not exactly the same group, unless people decided to roll into it.
It's fascinating. Well, what do you think of, this is more a philosophical question, but a lot of consumers just broadly, and I feel like this narrative has become more popular over the years, they blame private equity for killing businesses, especially when it comes to franchises. I think Carvel is actually a great example of that. Panera is another one. Now people are worried about Jersey Mike's because they just got acquired. The common thought is Jersey Mike's is about to go downhill now that Blackstone owns them. So just given that perception, I mean, how do you view private equity as actually being a force for good that, where your whole motive isn't to just destroy the business and then sell it and destroy value, which I just feel like it's become such a common thing out there, is that that's what private equity does. They actually kill businesses. They're not trying to increase or improve anything within it.
Yeah. I mean, it kind of depends. Like private equity is this big group in terms of any equity capital that's private versus it being this monolithic thing. And so, like what we do is very different than what like a big buyout firm might do. We talked about for us, we're trying to buy things at prices where we feel like we can have a good outcome if we have steady but not crazy growth over a long period of time. But I think what people are generally referring to with the PE model that they don't like is if you're buying a company where the game plan is to put a lot of debt on it and then to cut a bunch of costs so that your earnings in the short term are higher, even if in the long term that has a negative impact, then you're going to transact in the next few years. People don't love that. And when you put a lot of leverage on a business, there's always a chance that the business doesn't perform and you have a bankruptcy or something like that. With that said, the people buying these businesses after the PE firm, other PE firms, like they're not dumb. Like if the PE firm came in and like ruined the business and just propped it up for a minute, the next buyer is not going to value it that highly. So I think it's like, there are certainly some examples of private equity firms coming in and hurting a business, but I don't think that's ever really the goal, because for them to have a great outcome, them growing the business and turning into a better business, the next buyer is going to pay more for that. And so I think it's a little bit more of a narrative than it is a real thing, but that's not to say that out of the hundreds, thousands of businesses that get bought over whatever period by private equity firms, that like they do a bad job with some of them, right? It's hard to run businesses well. There's a failure rate for all of these things. I don't think that private equity is buying these things with the plan to ruin the businesses, but sometimes it's a little bit more of like a leverage and cost cutting play than it is a growth play. And obviously just sometimes things go wrong.
Yeah, I think two big takeaways there is it's business. Business is hard. Sometimes shit happens and it goes wrong. Nobody wants that to happen. But yeah, secondly, which is the first point you made, private equity, you're right. It is, at least just in your average media outlet, it's referred to as just this one thing. But there's so many different subsets that maybe roll up to that umbrella term, where there's growth equity funds, there's what you guys are doing. Yeah, there's so many different funds, and almost strategies within the game. And yeah, I think everyone just thinks private equity equals Blackstone equals bad company that wants to own everything and hurt me. So
the best outcomes these PE firms have had is when they've done a good job running the business and growing it, right? Like that's better than the alternative. I think, anyways, we won't go deeper on the PE thing. I think there's some things people don't like if you can put a bunch of debt on the business and have one fails, it's on that business and not on the fund and stuff. But generally, I don't think PE firms are setting out to tank things. But to your point, what Kyle did at Apollo and what we do, it essentially has almost no overlap. It's just two totally different worlds. And I think even in the lower middle market, we get told every time we meet a seller, you guys are just seem very different than generally the PE firms we meet. And it's kind of by design, right? We have sort of different strategy, and also we're not trying to present as this corporate PE thing. We're just trying to partner with good brands and grow them over a long time. And I think there's trade-offs to all these things, right? When you leave Apollo to do what we do, if you care about prestige and wearing a suit to work and whatever, that's not going to be a good fit for you. But if you enjoy the small business world and sort of operating these businesses, the sort of opportunities that come with going down market and all that, I think it's a really interesting thing. But sorry for the tangent. It's just funny because it's just so sort of almost unrelated to what's going on at a mega cap PE firm. We just don't really operate in the same world.
I think it's a really good call out. There's so much nuance within the world of private equity. I mean, frankly, it's kind of misleading, not once you position it like that, of how different you guys are versus a mega cap. So I think it's good for people to know. Just, you really got to evaluate the company and the firm on a firm by firm basis, because there can be a lot of variance. So yeah, man, this has been an awesome conversation. Where could people who want to follow either you, Tucker's Farm, Wonder, is there any good spots online where they can follow along and or get in touch maybe?
Well, I think this is going to sound funny, but our most public-facing thing is Kyle Tucker on LinkedIn. So follow him to see what our business is up to and his thoughts. I don't do a ton of public-facing stuff generally. I think I try to direct more of that to our portfolio company levels. But, check out Pizza Factory, check out Christmas Decor. If you need any holiday lighting services coming up, give them a call. And then Soccer 5 is an exciting one. We've got another business closing later this month that we'll announce. But, check out Wonder Franchises, check out Tucker's Farm, and follow Kyle on LinkedIn and Twitter, and you'll get our updates.
Yeah, I agree. Kyle's good on the posting on LinkedIn and Twitter. So I'll post all those links, folks, so you can follow along, check out the websites, and get in touch on LinkedIn with these guys. And yeah, I'm excited to see what the next brand is. And yeah, maybe we'll have you on again in a year or two to kind of talk more about the PE game.
Awesome, man. Well, I appreciate you having me. I think this is the first podcast I've ever done. And so hopefully next time around, I'll have a better idea of what I'm getting into here.
No, this is great, man. And honored to be the first pod.